Okay, so let's put that up here real quick. We need the value of operations, and that is going to be our expected free cash flow over our WACC minus our growth rate. We're going to add to that any non-operating assets. Right, remember all the assets that were investments, things like that, instead of operating assets? So add all those in. That'll give us the value of the firm. Then we'll take out any debt, any preferred stock. That will give us the value of the common equity in the firm. We'll divide by the number of shares, and we will get the stock price. Technically, we don't get the stock price, we get the intrinsic value, but we're going to say we're in equilibrium, so they're one and the same. Okay? So we'll say they're equal to each other. Okay, let's do this one as it is up here, and I left something. What did I leave? Left my calculator. There we go. All right, let's see, what does it say? It says 48 million free cash flow. We've got a WACC of, 48 was the most recent. It's expected to grow at 6%. So it's going to be 6% higher than that. The WACC is 12%, growth rate is 6. So let's see, what's 48 increased by 6%? That is going to be 50.88 over 6% difference. So divide by 0.06, 848. So that's going to be $848 million there. We got 30 million short-term investments, non-operating assets. So 878 million. They've got debt and preferred stock. Let's take those out. So 368 and 60. It's 450. And it says we've got 15 million shares of common stock. So that's going to give us a price of $30 per share. Okay, so that's where they stand right now. So they're asking A and B, what's the value of operations? What's the price of the stock per share? Boom, to the top and bottom of that. Okay. And C, right? So A, B, C. All right, so let's see, what are we doing here? The firm has 30 million short-term investments, which it plans to liquidate, turn to cash, and then use to repurchase stock. Okay, so let's do this here. We'll do a, let's just put A up here. And so for case A, it's going to be the problem as it stands. We're going to repurchase at $30 per share. Okay? You think, well, could we repurchase at a different price? Yeah, and that's going to be important. We'll see that in a bit. That's going to be my revision to the problem that we'll do. So let's see. That won't change. Stock repurchases do not affect operations, but it reduces your cash and non-operating assets. We're going to liquidate all that, pay for the repurchase. So the value of the firm is going to be smaller because we have fewer assets left. We'll take out our debt and our preferred stock, and now the value of equity is going to be lower. In fact, that's the only thing that really suffers, right, is equity shareholders are going to bear this because You don't reduce how much you owe on preferred stock or how much you owe to creditors when you do a stock repurchase. But now, let's see what's gonna happen. We're gonna do 30 million, right? That's our non-operating assets at 30 bucks per share. So that looks like 1 million shares. We're gonna repurchase 1 million shares. So let's see. So we're gonna subtract out 1 million, and that's gonna give us 14 million remaining up here. And what do you think would happen to a company's stock price as a result of a stock repurchase? What would it do? What do you think would happen in the marketplace? Up? Usually, you know, who announced when GM announced a big dividend increase in the stock repurchase yesterday. They announced it yesterday. They haven't done it yet, and their stock price skyrocketed as a result of that. But look what we have here. The equity's lower because of the amount repurchased, but because we lowered the number of shares, the stock price is the same. A stock repurchase in and of itself does not increase stock value. Okay, that's the importance of this problem right here. Yes, if you go out and you collect the data, do company stock prices tend to stay the same after repurchase is announced, or do they tend to go up or down? They tend to go up. But it's not because the mechanics of repurchase, right? Remember how yesterday we did, like, there's this pie and you split it to more wedges with a stock split, things like that? Here, we're taking a slice out of the pie, right? The part that we're repurchasing. But and we're taking, so that slice represents some shares and it represents some company value, but what's left over has the same value per share, right? Is what's happening here. So there's that. Let's go change this. Let's now do a repurchase at what price do I want to do this at? I'm gonna make the math easy here. Let's do 60 a share. Okay? I'm gonna, for anybody, so remember, let's think about this real quick. Before we do that, let's do one more thing here, okay? So this is gonna be for A. Investors who sell their shares. Let's just say, let's just do this for one share. Right, you're an investor, you had one share of stock, you had 30 bucks of investment in this company, okay? You had one share. So you've got stock, you've got cash, and you've got total. So if you sold your shares, you've got no stock, you've got 30 bucks in cash, so 30 bucks in wealth. If you keep your shares, you've got 30 bucks in stock, no cash, you've got 30 bucks in wealth. It's just, you just redistributed how you have your wealth, is all, okay? Why do I make that distinction? Because there's still 14 million shares outstanding, which means there's a lot more investors who kept their stock rather than those that sold their stock. Now, normally when you guys go trade shares of stock, who do you trade with? Other investors. But when there's a repurchase, you're selling them back to the company that issued them in the first place, right? So that's the distinction here too. Okay, now let's go back to B over here, where I'm running the company. I decided to repurchase the stock not at the market price of 30, but at a higher price, double, 60. So I'm still gonna go and do $30 million repurchase, but at 60 bucks a share, that's gonna be 500,000 shares. So now, what's gonna happen here, in this case, this part all looks the same, all the way down to the equity portion. But now, we're going to get right here, 15 million shares originally, minus 500,000. We're gonna have 14.5 million shares left. And so $420 million divided by 14.5 million shares, we get 28.97. Which is a loss of $1.03 on 14.5 million shares. So let's see how much. So it's that times 14.5. That's a total loss of $15 million. Who did that money go to? It went to those who sold their stock, right? So that we have a wealth transfer here. So the people who sold their stock got, those who sold their stock, they got $60 a share times 500,000 shares. That is, oh, no, sorry. The stock was at 30, but I paid you guys 60 for it, so you made $30 a share profit on 500,000 shares. That is a $15 million gain. There we go. So those who didn't sell their stock are worse off collectively by $15 million, and those who sold their stock are better off collectively by $15 million. We can do this on a per share basis, but you get the basic gist of it, right? So you're better off here if you'd sold your stock. If you kept it, you're kind of screwed a bit. You've lost some money. You've lost $1.03 a share times however many shares you have. You're not too happy with that. Okay, put that away. I get to sit down for a bit.
I think
Let's
that's
get
the
this
first
into the term.
time I've ever seen you sit down.
It's probably gonna happen the rest of the semester.
Yeah.
You didn't see him, I didn't see him.
Not in this chair though. No, no way, it's over there. This one's looking to better. Okay, let's see. So what's going on here? Remember we talked about the various ways that companies can repurchase stock? One is an open market repurchase. They basically buy it at whatever the market price is. Now, granted, if I'm running this company and I'm gonna buy back 1 million shares, that's a lot of demand. It's probably gonna bid up the stock price. So by the time I finish buying the shares, I'm not paying $30 anymore. I'm probably paying higher. But still, I could do it at the market price. And maybe I spread it out over time, so there's not much increase in demand, so I'm getting it about $30 a share. I could do that. So there really is a question, why in the world would I pay $60 to buy back what I could have bought back at 30? You guys are the outside shareholders, I'm the CEO. Do you need to go and vote me out of my position if I do the 60 instead of, how come?
Well, you mentioned that you can signal to investors that you think the stock should be worth more. So that's why you're buying it at 60 rather than 30?
Yes. So what I did in Part B is what's called a tender offer. A tender offer is where I am offering, the firm is offering to buy your stock back at this tender offer of 60 a share. A premium of $30, but since the original price was 30, that's 100% premium, right? 100% per share premium. What does that signal to you? It signals to you that I believe, I'm not wasting corporate resources by doing this. It signals that I, the CEO, management believes the stock is worth 60 a share, and that's why I'm willing to do it, right? So when you see a tender offer, which is gonna be at a price above what the stock was trading at before the tender offer, right? Tender offers are at a premium, maybe not double, but they're at some premium. What management is doing is they're signaling to the marketplace that, hey, management believes the stock is worth a lot more. That you guys have it wrong, the stock is undervalued. So correct this mess, right? And here's what the true price is, it's the tender offer. So what would happen if you guys believe that signal? What do you think is gonna happen to the stock price? Say it again?
It's gonna go up.
To what? To 60. So it won't drop at 28.97, it'll go up to 60, so it's a win-win. Everybody wins, right? It doesn't matter if you tendered your stock or if you kept your stock, because the stock price should go up to the $60 price for everybody. Everybody's gonna come away with big gains on it, either a realized gain because you sold your stock, or an unrealized or paper profit because you kept your shares. So that's what's gonna happen there. So the relevance of a stock repurchase is that it is a way, with a tender offer, is that it's a mechanism for management to transmit a signal to the marketplace that the stock is undervalued. And they're telling you by how much, right? You compare the tender offer to the original stock price before the announcement was made. Not when the repurchase was done, but when the announcement was made. And now you have basically what management thinks is the difference, how much the stock's undervalued.
How much does it typically go all the way up to, say, 60? Or is it more?
Yeah, so remember, companies, like when I announce a cash dividend, for that dividend, I'm obliged legally to fulfill it, right, to pay it. I can't pull the rug out from underneath you. But when I announce a repurchase, the announcement's different. It's not, I will do this, it's that, it's basically we aspire to do this, right, during this period of time. So it means a company could do all of the repurchase, some of it, or even none of it. Now, I don't know this, but I suspect legally if companies announced repurchases and kept reneging on them constantly, they'd find themselves under a lawsuit. But could a company go announce a repurchase, like say 10 billion in shares, and only do 5 billion, or market changes and they hold off and say, no, we're gonna not do the repurchase this year like we had planned. We'll look at it again next year. Yeah, they could do that. Right, so in that regard, maybe the stock doesn't go up as high as what we think, no, as it should on there.
Do they kind of do the same thing where they do like percentage chance, like whenever they're doing acquisitions, so there's a 60% chance?
Yeah, that's why, it's the probability of, it's the uncertainty regarding whether it occurs or not. Right, so I guess the best way to describe what's the benefit of a stock repurchase is a signaling mechanism. All right, that's really what it is. We know it has a tax preference, or a favorable tax treatment, right? Your tax at capital gains rates, the change in stock price, versus income tax rates on dividends. So it's got that. Remember the tax preference theory. It's more flexible. So companies that are maybe still growing fairly rapidly, like the shakeout stage, might be inclined to do repurchases because they're not obliging themselves to a dividend that they might have to cut later if they're not really in the shakeout. Maybe they're still in the growth stage instead of shakeout, right? Maybe their growth picks back up and they want more capital in the future. They might have to cut a dividend, which they don't want to do. But a stock repurchase, companies don't do those every year. In fact, they do them infrequently. Even companies that do regular stock repurchases do them infrequently. So they're not the same kind of, there's not this notion amongst investors that, hey, this company's going to always repurchase stock, going to repurchase this amount per year. There's none of that like there is with dividends. Put differently, investors don't tend to buy companies that repurchase stock for the cash flow, but they do buy companies that do dividends for that income or that cash flow they receive from the dividend payments. Okay, that wraps up that chapter. Now, I said I was gonna sit down, back up. So now let's go ahead and get into final chapter. Let's get into the one on mergers and acquisitions.
Isn't this chapter 24?
26.
26, okay.
Yeah. Yeah, it's way too, is it the last, it may be the last chapter in the book. It's close. That's the only reason I picked it, just because it's the last chapter in the book. Okay, so, as it says, mergers, LBS, leveraged buyouts, divestitures, selling off part of your company, and holding companies, which we're not really gonna be talking about in here. What we're really talking about are mergers, which is, well, we'll get the terms in a minute. Let's know about first what's going on here that makes this chapter important. This gets back to growing your firm, and there's two ways that firms can grow. They can grow internally, and that simply means like CVS. How would CVS grow internally? They build new stores, right? They say, oh, we think there's enough market in Nacogdoches to put a second CVS store over on University Avenue. That would be internal growth. What would CVS do in deciding whether or not to put that store on University? They do basic capital budgeting analysis, right? Build your cash flows, compute the net present value, hopefully it's positive. Maybe there's some options embedded in this, right? Maybe there's some uncertainty, so they do scenario analysis to see if the expected NPV is positive. And they do that, and if it's positive, they go ahead and do the investment, right? That would be internal. What's another way? What if CVS says, you know what, there's a faster way to, doing that, we have to go and find the land. First, we have to go through all the capital budgeting analysis. We have to find the land. We have to get, we have to purchase the land. We have to get building permits. We have to get everything built and then stocked and get people trained. That's gonna take a lot of time. Maybe it takes a year, right? Maybe on the fast track, we can do that store in a year's time. Is there a faster way? Could we pretty much have a new store in NAC almost overnight? Yeah, let's just buy one. Let's see, CVS decides they're gonna buy Walgreens to get that second store, right? That would be an acquisition. It would give them that extra market, that acts, large enough market for two stores. Well, there you go. That might take care of it there. And so, an external growth, right? Acquire another firm, acquire Walgreens, acquire Rite Aid, things like that. In fact, I think it's Walgreens and Rite Aid looked at merging for a while, or Walgreens is looking at buying Rite Aid at some point, and that got scuppered. And it's a rapid form of growth, right? It's quicker. You've already got an existing business. There are downsides, and we'll see what some of those downsides are in this chapter. Okay, so that's the big motivation there, right? It's about growth. And by the way, some companies stay on the internal track. Again, we'll see why that may be the case, and it's slower to grow internally. But some companies stay on that track. And I'd make the contention they do better for their shareholders. Other companies have pretty much grown in history the fast track method of mergers and acquisitions, buying other companies. They look more attractive because they're growing really fast. Growth seems to be good. But remember what we saw in here about value drivers? Growth is only good if your returns are above your cost of capital. Remember that? So keep that in mind in this chapter. If you're growing, but your returns are below your cost of capital, you've hurt shareholders. If your returns are equal to your cost of capital, you've done them no good. You haven't hurt them, but you haven't done them any good either. Only if returns are above the cost of capital. And that's what happens when the NPVs are positive, by the way. So keep that in mind as we're going through here. Let's get some terminology out of the way. some basic terms. Technically, a merger is combining firms, so you could say a merger, of equals. Where an acquisition is one firm is buying up or snapping up the other firm. Well, lots of times I'll use those two terms interchangeably in here. And for most of our purposes, it doesn't really matter if it's a merger or an acquisition. The end result financially for us, a lot of the times, is the same. Maybe the management people might say there are differences, like who gets to stay and who goes, things like that. But for us in here, it's gonna be mostly the same between a merger or an acquisition. LBO and MBO, leverage to buy out, which means what? You borrow a ton of money, that's the leverage. Use all that money you borrowed to buy up all the stock. Like how much? Every single share. You buy it all and you take the company private, right? It's no longer a publicly traded company because you bought all the stock. And you've, what they say, taken it private, right? You are the sole owner. Or if you run a company that's done this, you've taken it private, then you're the sole owner as a company. Not the same as an acquisition, right? You're not absorbing it to another firm. An MBO is a management buyout. That's where the existing management of a firm decides to go and borrow all that money, get all that leverage, and use it to buy every outstanding share of the company and take it private. So, an LBO could be an outside entity, an outside group, borrowing the money, getting the funds, buying this company over here, taking it private. This happened a number of times. For example, Burger King, about 20 or so years ago, got bought up by a private equity firm. That private equity firm borrowed a ton of money, took all the borrowed money, and bought up every single share of Burger King, took it private. Why? They picked Burger King because it wasn't being run too well. There's a lot of room to make improvements. But because the marketplace has more of a focus on the short term, like what are your earnings going to be next quarter? So every quarter, that creates a short-term focus sometimes. So the private equity firm decided it might be easier or more efficient to get Burger King more competitive, make them run better if we can take them private, so the short-term focus is gone. We might take them private for a couple of years, and now they have a long-term focus, right? We've got a 2-year target instead of a 3-month or quarterly target to work on. We're not trying to maximize earnings per share in the next 3 months. We're trying to maximize the overall value of the firm over the next 2 or 3 years, and then what will we do? We'll take it public again and sell the stock, hopefully at a big, hefty price that gives us a big rate of return between what we took it private at versus what we sold it. So that's happened a number of times. Management buyouts. Some time ago, Michael Dell, who founded Dell Computer, took Dell private. Did the same thing. I think he's gone back public since then, but he took Dell private. So that was a management buyout. Same basic idea, right? Get away from the short-term market focus. Maybe you've got a longer time period to make the changes that you need to make. Tender offer, that was this thing right here, right? A tender offer is where a company is looking at buying its stock back, but it decides to buy it to, an offer. I'm management. I'm offering $60 a share to any and all of you who will tender your stock to me, the company, right? So that's my offer to you if you tender your shares. So tender offer. That's important because when you have a bidding firm trying to acquire a target firm, they're going to put out a tender offer on that target firm's stock, right? So not buying back their own shares, they're buying back the other company's stock at the tender offer. Let's look at types of mergers. We've got several ways we can classify these things. So here's one way of classifying them. Horizontal, vertical, congeneric, and conglomerate. And I've given some pretty ridiculous examples here of each. So, same line of business as horizontal. Krispy Kreme buys, or Dunkin' buys Krispy Kreme. What's happening? If you said, I've gone and done some analysis and I've estimated the size of the donut market in Nacogdoches, it must be huge because there are donut shops everywhere, right? So the annual potential donut revenue is this right here. And I think if we had most of the shops, we'd have something of a monopoly on donuts in Nacogdoches, and we could bump up the price and act like a monopolist, right? You might have market power. So horizontals are all about reducing competition and therefore having more control over prices. That's what market power is doing for you, right? Vertical, different stages in the product cycle. You could, nowadays, we know the term for that. We've seen it when we talk about inflation. Supply chain, right? Here, supply chain, like, GM couldn't make SUVs for a while because they needed computer chips for all the little sensors and everything. Supply chain, right? What if GM had its own supply chip manufacturing business to make exactly those chips? Maybe they wouldn't have had an issue, right? So they would have controlled that part of the supply chain. So here, Dunkin' buys the wheat farms that supply the wheat to Dunkin', and they buy the mills that mill up the wheat into flour, right? Maybe Dunkin's making a ton of money every year selling donuts, and the wheat farmers and the wheat mills know that, and there are not many of them. Dunkin' goes to a certain select group of wheat farmers, and there's like only one mill around. And Dunkin' said, the mill says, you know what? We're the only game in town. They've got to go through us. And so we can charge higher prices on milling the wheat for Dunkin'. And would we charge a higher price? Yeah, they're making a ton of money. Let's get some of that money for ourselves. So if Dunkin's making a lot of money and that suppliers see that, and then they might charge higher prices to Dunkin'. Now, if there's a whole bunch of potential suppliers, like a bunch of farmers and a bunch of wheat mills, Dunkin' could go change out suppliers. Cuts their power. This is all about Porter's 5 forces, those competitive factors. But if there are not many alternatives to the wheat mills that are out there and the farms that are out there, then they could charge a higher price because there's no alternatives for Dunkin'. So Dunkin' could get around that by buying those suppliers, right, if they have power. And that removes that competitive force away from Dunkin'. So you can do what's called backward integration, which means buying parts of the supply chain further back, earlier part of the production cycle. And you would do that if they have market power of sorts over you. You could go forward in the supply chain. Like, Dunkin' has its own stores, but they also sell donuts in grocery stores, right? So maybe Kroger is giving them a really low, won't let them sell them at a high price in their grocery stores, and Dunkin's tired of that, so they say, okay, we're gonna go buy up Kroger so we can sell our donuts at a higher price, right? So they forward integrate. They go forward or further along the production cycle in the supply chain. So those are all about things like about supplier power, customer power, and also barriers to entry. If you got the whole supply chain, earlier in the production process and later, you've got all that wrapped up in-house, then you've basically constructed a big barrier to new competition coming in and competing against you. Congeneric, let's see. Dunkin' buys Folgers. Related industry without horizontal or vertical links. If you're thinking economics, that doesn't sound like substitute goods, that sounds like what? Complementary goods, right? So I guess if this really was an economics class, we'd use the standard one that they always use is pizza and beer, I guess, right? Yeah. So that's all economists, is that what they use now? Pizza and beer? That's in my day, who knows what they do now. So, right, two things that go together, right? So, I drink coffee, I want donuts. I have donuts, I want coffee. So maybe we sell more overall if we have those two things together. So that's the idea there with a congenerate merger, is that they're complementary goods. And then a conglomerate, so this comes out of geology. A conglomerate is a rock that's basically a mishmash of all kinds of different unrelated stuff, just smashed together into a rock, right? So, and here in business, a conglomerate business is a bunch of unrelated business units that have no, there's no rhyme or reason that they're together. They're put together, right? So here we've got the example, Donuts acquires Dell Computer. Like, why would they acquire Dell Computer? They don't need Dell Computer to make donuts or sell them. No, that's the whole point. Their revenue streams should be uncorrelated with each other. And if they're uncorrelated, that means less risk. So it's basically a portfolio or a risk reduction based strategy here, right? Diversification. So when you have uncorrelated risk, that you reduce your risk overall. Then when correlations are high, you guys should know that in Jadici's class. You either nod favorably or he's going to hear about this.
Yeah.
So.
I was gonna say, is this more like Amazon with like their Amazon Video and?
Well, let's see. So Amazon does lots of things under their, their original, online stores, right? I would say there might be a lot of correlation on those things. But then they also do Amazon Web Services, cloud computing. Now that's very different from their online storefronts. So, and you might say, what does cloud computing really have to do with their online stores? If the answer, it turns out to be nothing, then you would say those are uncorrelated revenue streams and cash flow streams. And that's a risk reduction mechanism there, right? It makes them something of a conglomerate. General Electric is one of the classic examples of a conglomerate. They've got their old original lighting division. That's what started them, right? The light bulb. They started out as Edison Electric. They've got, I think, a jet engine division, like for aircraft engines. They've got another one for electrical generation of power units for utility companies. I think they've got a medical unit, and at one time they had a GE Capital, a financial unit. And you say, why would they have all this diverse stuff? Building a conglomerate, so the revenue streams are uncorrelated and they've reduced risk. So if the financial arm doesn't do well because interest rates are high and no one's borrowing money, maybe the other units do well, right? So they're still generating revenue and cash flow in parts of their business when other parts might be more prone to a recession, right? Things of that nature. So that's the basic idea there, is let's diversify, let's spread out our risk. I'm going to skip that slide that just says everything that I just went over. That one. Okay, so that's how we can classify mergers in those four different buckets right there. They're one of these four: horizontal, vertical, congenerate, or conglomerate. That in mind, that tells us a lot of why companies merge or acquire another. You might be trying to eliminate competition. You might be trying to reduce the power suppliers have or that customers have, right? Someone in the supply chain. You might be trying to reduce risk by diversifying. So that pretty much helps us classify mergers in terms of their motivations. So we can do them broadly two ways. We can say they're either synergistic, and synergistic means I add A and I add B, and the sum is greater than A and B together, than the parts, right? It's financial math. So here's unit A, it's worth $10 billion. Here's company B, it's worth $5 billion. And we added them together and we got company AB, and it's worth $18 billion, right? There's modern math right there. And so you say, what are the synergies here? Well, the synergy must be the extra $3 billion that was derived by putting these two together. That's the synergy. So what led to that extra? Where did that gain come from? Did it just crystallize out of thin air? Did the market, You know, did the market just decide that a merger must be worth more than the sum of the two individual firms, or is there some legitimate financial reason for that? So, synergistic, there's a legitimate financial reason why the two things together are worth more than they are separated out.
Would the main reason be like cost reduction?
That might be, that's one, that's a possibility. And there's others too, but that's potentially one, right? I don't need, like, firms have a lot of overhead, right? Like corporate headquarters staff. Do I need two corporate headquarters staffs to run the combined firm? Maybe not. Maybe I can get rid of the equivalent of one of those sets of staffs, and that might save me a ton of money, right? It may not be 10 or 12 people, it may be thousands of people. I might be able to really cut our expenses a lot, and that would be an ongoing reduction, right, every single year, eliminating those salaries. And maybe we've got leases on property, we don't need them both, so we can get rid of one corporate headquarters. So they either create more than they were worth individually before the merger, or, so this would be synergistic. Or if we said A, 10 billion, plus B, 5 billion, equals the combined firm, 15 billion, that's our financial merger. And there's some things that fall under that. Let's look at the synergistic ones first. We'll spend almost all of our time on it, and the reason why is this. Almost every single merger or acquisition, and they're all, that's announced, and they're all announced, it's like a dividend, they're all announced to the public. Because the companies that are getting involved in this, they want the public to think this is a great thing, and hopefully to get their stock prices bid up. So they're always going to announce it, and whenever they announce it, almost universally, it's some kind of synergy involved. So let's see what the synergies could be. Cost is one of them that we'll find. Excuse me. And there are some others as well. So one of these is going to be operating economies of scale. And you could say that's where the costs come in. So cost synergies are basically reducing costs, right? Reducing expenses at the corporate at the company. So we might have duplicate expenses in the combined firm. We can eliminate the duplicate part and cut it out, like corporate overhead, right? The headquarters staff, that's a possibility. Another possibility is, in some industries, the more units you make and produce and sell, the lower the cost per unit, right? You're spreading out your fixed cost on more units. And if you were a larger firm with more production, you spread out your existing fixed cost over more units, it's gonna reduce your cost that way, right? A per unit cost. So economies of scale. So economies of scale, reducing corporate overhead by eliminating that redundant second corporate headquarters, things like that, will be under the economies of scale, right? Reducing cost. Financial economies of scale, what's that one? We didn't talk about this in capital structure or the cost of capital, but whenever a firm raises capital, either debt, common equity, or preferred stock, whenever they raise those funds, they go through investment banks to do this. And investment banks charge them, right? They charge underwriting or float fees to do that. And investment banks have to do a certain amount of work, no matter whether it's a small amount of capital being raised, like we just need $50 million, versus a large amount, like we need $50 billion. There's a certain amount of paperwork that has to be done no matter what, like registering the securities with the SEC, making certain all the information is collected and is accurate. So there's some expense there. It's a lot more efficient spreading that cost amongst a $5 billion capital issue than a $50 million capital issue, right? So you can see why. So a company that's larger tends to raise more capital than a small company, and they cut their fees on a per share basis, or for the amount of capital raised, it's a lower amount of capital. So in other words, maybe you're paying out 10% of the capital raised for that $50 million issue, maybe you pay the investment bank $5 million. You think, could it be that high? Yeah, it could. Equity issues, they can be really high. But maybe a $5 billion issue, maybe your fees are only 1%. So that would be $50 million, which is a lot more than small company, but it's a smaller percentage of the capital raised. So it's less costly to do that. That's financial economies of scale. Large firms can raise capital at a lower cost per dollar raised than a small firm. Taxes. Got two firms. So here's firm A, and firm A has earnings before tax of minus $10 billion. They're losing some money. And here's firm B. They've got earnings before tax of $10 billion. And then our tax rate, which we're gonna make 40%. Now, normally what we've done in here, let's see, so company B would owe $4 billion in tax. They'd end up with net income of $6 billion. Now what do we normally do here? We normally say, let's put 4 up here. Let's make it positive like a tax credit, right? But that won't work if we don't have any prior income we could get a credit against. We'd have it to carry that number forward, but we wouldn't get anything right now, right? We get it at a future date, but not now. So that credit won't do us any good if we don't have any prior taxes that we've paid that we can go and kind of recover it on. So we're still out right here with our net income. So what could we do? Well, what if we combine these two firms, A and B, and we could take this loss right here and offset it against that income right there, and that means the tax bill would be 0. Right? We could use this right here, or maybe this firm has a bunch of tax losses from prior years and never been able to take advantage of, and we can use those. But they're hoping they can in the future. That's only if they become profitable. If we bought that money-losing firm today, we could take advantage of all those prior losses, all those tax credits. We could take advantage of them right now and utilize them. Right, so that's basically transferring like unused tax credits from one business to another, so they can be used immediately instead of sometime down the road. Market power, that's where, said, that's where Dunkin' buys Krispy Kreme. They reduce some competition, so now they've got more market power. They can raise prices more freely with less competition. Differential efficiencies is book the authors are using. All that one really means is you've got a poorly run firm. You've got management who doesn't know what they're doing, and they're doing a really bad job, and the company's worth a lot less than it could be. Put differently, management who knows what they're doing could turn that business around and make it worth a lot more money. That's all that is. So you're getting rid of bad decision makers and putting in good decision makers and raising company value as a result. So the synergies in that last one aren't we reducing cost or getting rid of corporate overhead. It's that we're realizing the true value of a company, not because it's undervalued, it's fairly valued at a low price, but it could be worth a lot more if we had people who knew what they were doing in running the company. And that's where that one's coming from. I've got several of these in here. I've got some of these press releases on these things. This is one from a few years back, so summer of 2019, where pharmaceutical firm Bristol Myers was looking at buying another firm in the same industry, Celgene. And kind of hard to read it, but down here they're listing Bristol Myers Squibb, the bidding firm, reaffirms significant value creation opportunity of the acquisition of Celgene, together with 2.5 billion in cost synergies. So that was one of their motivations for the acquisition, is that we combine these two firms, we can get rid of some redundant expenses. Maybe there's some economies of scale we can realize, and it's gonna save us 2.5 billion a year in cost every single year going forward, and that is gonna increase value. Let's see what happened to these companies when this announcement happened. So here's their stock price. Here's Bristol Myers, here's Celgene, so the bidding firm, the acquiring firm. Here are their stock prices the day before the announcement. And here's what happened to their stock prices on the day of the announcement. So Bristol Myers dropped by, what is that, maybe 20%? Or not 20, about 10, 15% they dropped. I guess right here, 13. Pay attention to my own slide. So they dropped by 13%, whereas Celgene went up 51% on the day of the announcement. What does that tell you right there? Remember, this whole merger or this acquisition, whichever you want to call it, was predicated on a synergy, right? Cost synergy, $2.5 billion. So, who's winning and losing in this deal, this potential deal? Yeah, the markets assessed it, and the markets decided that this looks great for Celgene shareholders, but it looks awful for Bristol Myers shareholders, right? Bristol Myers was the buying firm, the acquiring firm. The target firm is Celgene. So the markets decided this is a great deal for Celgene. It's not good at all for Bristol Myers shareholders. And you say, why? There's this big synergy. Why could this be a good deal for one party in this and a bad deal for the other? What do you think? We see what it was. They announced it would be an offer of $102.43 in cash, and combined cash and Bristol Myers stock. So basically, here's what Bristol Myers was going to do. They're going to say, hey, you Celgene shareholders, give us every share of your stock, and in return, we're going to give you a combined amount of stock in our company plus some cash as well. And it'll total 102.43 up there. Think about, let's see, what does that mean for Bristol Myers besides the market saying that it's bad? Say again?
Are they diluting their shareholders?
Are they doing?
Diluting their shareholders?
Not necessarily diluting them. Let me go back up to this slide. Let's go way back up here. This internal, external growth. Internal, like CVS is looking at building a new store in Nacogdoches. So it runs through the basic capital budgeting analysis, and it should only do it if NPV is expected to be positive, right? Adds value. What would happen if they did a project where NPV was expected to be negative? What would happen to CVS's stock? What should happen? It should fall, right? It should fall. Or as we said, put differently, if the returns on the investment were lower than the cost of the investment, they should lose value. So you look here and you say, Bristol Myers has dropped, at least the market has reduced their stock price. They've been selling it because they think that at this price right here, the amount being paid by Bristol or offered by Bristol Myers exceeds the benefit, right? It's a negative NPV investment, this proposed acquisition. And so the market is penalizing Bristol Myers shareholders, saying, you pay too much, we're gonna cut your value by 13.2% as a result of overpaying for this company. On the other hand, Celgene's come out the big winner. How so? Well, you would think, now, if you didn't see this, you'd think they should both have come out ahead because of the synergies, right? Or shouldn't they both have gained some? So the only way, so what it means is, they've overpaid, that's why they're dropping. They're benefiting, why? Because of both the synergies, that extra value there, and because they overpaid. There's two reasons they do better, those synergies and the overpayment from the bidding firm. Here is another example of this stuff. Here's where another pharmaceutical firm, Pfizer, was looking at a merger with an Irish pharmaceutical, Allergan. This was back, what was the date on this? This was back in 2016. It got scrapped. This was all based on the tax motivation, right? What was the deal about Ireland that was important for businesses, or used to be? Still kind of is, but not as much as it used to be.
Isn't it a low corporate tax rate?
Almost zero, yeah. You'd have lots of companies that have their corporate headquarters in Ireland. Why? Because the corporate income tax rate there was like a couple of percent. Whereas over here, you know, it was around 35% at the top bracket at the federal level. In Ireland, it was about 1/10 of that. So why not incorporate in Ireland, and the money that you have earned in that environment overseas is going to be taxed at, you know, whatever it was, 2 or 3% instead of 35%. That's going to save you a ton of money, right? So the tax benefit, that one got scrapped because the White House at the time challenged it in court. U.S. government doesn't like that kind of motivation, and so if they think that your motivation is entirely tax predicated, they'll take you to court and have it shot down.
Was it Apple that was doing a lot of like tax haven?
Mhm.
And
Amongst plenty of other firms. They're all doing it, because you're not violating the law, you're doing exactly what the law allows you to do. And so while people may not like it, it would be wrong if Apple and those companies weren't doing it, because they wouldn't be maximizing shareholder wealth, right? It's their responsibility to try to find, you know, minimize tax as part of helping to maximize cash flow and maximize company values. And that's exactly what they were doing. In fact, Apple did one better. You know, they were headquartered over in Ireland, and they had a ton of money overseas. I mean, hundreds of billions of dollars in cash and marketable securities overseas. The U.S. wanted it brought back over here so they could get tax revenue off of it. So that's why U.S. hated this idea of Ireland being an offshore tax haven, because of that. But then it's right around the time that Tim Cook took over, and shareholders started to revolt, like, you guys are accumulating all this cash, pay us a dividend, or invest the money in some project. Well, Apple's accumulating more cash than they could invest. And so this is back when their cash, their short-term investments, their long-term investments were well over $300 billion, right? Massive amount of money. So what they did was they kept their money overseas, and so remember exactly how they did this thing. They borrowed over here. They used the borrowed money to pay dividends and do stock buybacks over here. And then they were able to go and pay off the interest and principal on that borrowed money with the money from overseas. And since that's, you know, since they used it to pay off debt, they weren't taxed on that. So you can kind of see, when you've got different corporate tax rates around the world, you can see companies doing things like this, where they position themselves to reduce taxes, and that can be one of the motivations for these mergers and acquisitions.
Can the government only step in if it's like a public company, or would they still do that if it was private?
I don't know if they do it I don't know. I don't know. I mean, if you had like, what if Pfizer had done a management buyout and gone private, and then gone and done this thing? Could they have done that? I suspect, my thought is they probably would still go in and try to challenge it in court, because either way, the government wants to collect its tax revenue. And that's the whole thing right there, is collecting tax revenue. I doubt there would be any difference from the different point of view on it. Let's see. Remember we said it's either synergies, so there's something to be gained adding these two firms together, or there's nothing to be gained, but they still get put together anyway. So here are the three of the big ones here. Bargains. Let's look at what we teach you guys in investments courses. Find an undervalued investment, something that's worth more than it cost you, and buy it. That's the same thing there. Diversification, that's the conglomerate view. By the way, lots of companies like General Electric and other conglomerates have started to divest or sell off their assets, parts of their business. Why? They found out that a couple of things. Number one, conglomerates are really difficult for investors to value because there's so many working parts. It's difficult to figure out what the real value of GE is. It's easier to figure out what the value of, say, their lighting division would be if it were on its own, or their power division if it were on its own, or their healthcare division if it were on its own, than it is to figure out the value of this entire thing all mashed together with all their cash flows put together. So there's a complexity issue. It's really hard to value, to assess the true value of a conglomerate. It's so complex. So that would suggest it's more likely that conglomerates are persistently undervalued by the marketplace, and their value would be higher if those parts were split out. So that's one thing that's kind of led to diversification argument kind of going away. Another is this. When you guys have taken like Jadici's course in portfolio, and he's telling you about like the power of diversification, spreading your money around, it's actually easier for us as investors to spread our money around than it is for a company to buy different other companies that are unrelated to create diversification. So, because we can do it a lot more efficient, we can do it quicker. Like if I'm not diversified enough, I can add in some more companies into my portfolio a lot easier than GE can add more other businesses into its portfolio. So it's a lot more efficient to diversify at the shareholder level than is at the corporate level. So a lot of those old corporations that were conglomerates have, you could say, deconglomerated themselves, if you like that term. The other thing that kind of falls in this financial motivation or rationale is that last one, and it's the worst one of all of these, is this managerial self-interest. We'll always tell you guys, you never invest in something unless the NPV is positive, right? You always accept those. You never do an investment where the NPV is negative, right? But what if I told you when it comes to mergers and acquisitions that lots of companies do acquisitions where they have a pretty good idea it's going to be a negative NPV. It's going to lose value. They do it anyway. Why would they do that? Well, there's a couple of reasons. Number one, it's very difficult for the market to really assess. Right? If I'm running a company, I've got to report my financial results to you guys every 3 months, every quarter. I don't have to report what I did on an individual project, just my overall company numbers, right? So a project like an acquisition could have done pretty bad, just like a project could have done pretty bad, but I'm reporting the overall corporate cash flows to you guys. So I can hide some things, right? Can make it less transparent. Plus, it turns out lots of executives their pay doesn't go up because they found investments that had a positive NPV. They get paid more because the company's larger. They might get bonuses based on hitting sales targets. Or it turns out executive pay is a positive function of company size by assets. So companies with more assets, executives get paid higher compensation than small companies. So how could I get my pay up there? Every year I'm going to go out and buy another company. I'm going to double the company size every year in assets. And I expect over time, may not be every year, but over time my pay is going to go up pretty significantly because the company's doubling in size every year. And there's another thing too, it's a prestige factor. Every, executives want to be the person that says, we grew from here to here during my tenure at this company. We got there through acquisitions, and we went from a $100 million company to a $10 billion company in 5 years. We did fantastic, right? Maybe they lost a lot of value in that time, but they may have gotten substantially bigger. So that's empire building and managerial self-interest, where it might be harmful acquisitions that are actually reducing value, right? Reducing equity value, but the company's actually getting larger in terms of assets. It looks to people who are unaware like maybe the company did really good, right? How would you know that they did bad? It would take some time. You have to look at their financials over time, and you see them deteriorating. You'd see like return measures starting to get worse over time because of bad acquisitions. Like ROE might be declining steadily over the years because of a series of bad acquisitions, or ROIC is declining over time.
Should board members, look at these internal documents and try to assess whether or not the CEO is doing imperial building?
You know who the chair of most board of directors is? The CEO.
Okay.
Yeah. The boards are supposed to oversee management. Almost always, senior management sit on the board, typically at minimum the CEO, or usually just the CEO. But lots of companies, like Musk isn't on the board of Tesla anymore. He got forced out by the federal government. But before that, he wasn't just on the board, he was the chair of the board, and they pretty much would be called, they did whatever he said, right? They rubber stamped what he said. There are plenty of boards that do exactly like that. They don't oversee the company, they rubber stamp what management wants. And that happens more often than you realize. If the company's doing good, the stock price is going up, they're gonna rubber stamp it even though the decisions don't make any real sense. They're gonna do that. Then we're gonna start to scrutinize when the financial results aren't good anymore. But so yes, in theory, they're supposed to look over that. In practice, not so often. Let's see, a couple of things, and then we'll finish it up next week. Mergers and acquisitions are highly regulated by the federal government. Even state governments can go and scrutinize and constrain these things. So the book tells us about this Williams Act from about a half century ago, and this is about the bidder's offer. So it basically does this. It says, here's what used to happen. I would go and say, I want to buy you guys' firm. And I'm going to offer you, like your stock's been trading at 30 a share, I'll offer you $50 a share. But I don't need to buy every single share, just controlling interest, 51%. So I'm going to go and say, I'll offer $50 a share until I get controlling interest. And if you didn't sell me your stock, I won't pay anything after that, right? So the Williams Act, so basically if you didn't tender your shares soon enough, you didn't get that 50 a share, and because you're now a minority shareholder, Wonder doesn't have enough say in the company, because I have all the say, I've got controlling interest, I've got most of the votes. Your shares aren't even worth maybe 30 anymore, they're worth a smaller amount. So the Williams Act said, no, I've got to make that offer available for a period of time. In fact, it would also, because of that, it gave an incentive for everybody to tender their shares as soon as possible, so they weren't the ones left holding their stock after I got controlling interest, right? So it gave an incentive for you to sell your stock really quick to me at that offer. The Williams Act said, no, I've got to give you at least 20 days, and anybody who tenders their shares up, even if it puts me to 80% of the stock, doesn't matter. I may only wanted 51%, I may get 80 or 90%, I've got to buy them all. Any share that's tendered up in that window, I've got to buy at my offer price.
So if you had 49% of the company, and then you wanted to buy 2 more percent, you would have to offer that amount to the entire rest of it?
Yes, yeah, that's what that Williams Act was about. So I couldn't gain the existing shareholders for that period of time, and set them against each other, was the basic idea. Now, there's a couple others that are on the textbook that are worth noting. The Sherman Antitrust Act from 1890, basically, before that, if you guys have ever seen the series, I don't know what it's on now, The Men Who Made America, about Cornelius Vanderbilt and the railroad system, John Rockefeller and Standard Oil, Andrew Carnegie and Carnegie Steel, and some others. They built monopolies. The board game Monopoly was about those guys essentially, and it's about creating monopoly. So you've got pricing power, right? The whole idea behind monopoly. Monopolies weren't regulated back then. Standard Oil was effectively a monopoly in the oil business. So once they got all, he was getting all the refiners, and then he could control the price of kerosene. It wasn't gasoline then, it was kerosene to light homes and to heat homes. And he had an incentive to buy every refiner he could to corner the market on refining capacity so he could bid up the price of kerosene and extract monopoly profits. Well, the Sherman Antitrust Act made it illegal to form a monopoly, and so they could start ratcheting down on that. And then you had the FTC Act a couple decades later that created the FTC, the Federal Trade Commission, and it meant that they and the Department of Justice would review and either approve or deny mergers and acquisitions that are proposed. So like the Pfizer-Allergan deal would have to have gone up for FTC and DOJ approval before it could have gone through. And so why did they decide to cancel it? Because they realized they weren't going to get approval, right? So why go and spend more money, all the paperwork, all the process when you're getting signals that the government's not going to let this happen, right? So that's kind of the gateway right there. We'll look at more at the process to finish up on Tuesday, and then Thursday will be reviewed, and then final, right?
Okay.
Alright. Let me see the schedule before we go.
You're adamant, man.
And let me see your interpret dance class.
Oh my gosh. It's not finalized anyways.
Oh, it's not?
I got one.